The Bank of Canada has been maintaining near record low interest rate for the past 2 years. They're doing this to help stimulate the economy. Low interest rates encourage people to borrow and spend money during slow economic times so that we can return to a stronger period of economic growth. In the Bank of Canada's interest rate decision last week, they decided to keep interest rates the same. And they did this in part because they're concerned about the economic growth of the country moving forward, particularly with respect to commodity prices, oil and minerals. With these low prices, they're concerned that the economy isn't growing so fast and raising interest rates would only slow down the economy. Keeping them constant was a way to maintain stability and ensure economic growth continues. Low interest rates, while stimulative, could cause problems down the road. One of the biggest risks to the economic recovery identified by the bank was the level of household debt. Low interest rates encourage people to take on greater loans than they would otherwise, and if interest rates increase in the future, some people might not be able to afford to pay down their loans. If this is the case, the Bank of Canada would need to take action to ensure that households don't get too indebted. Household debt could be a real big deal for the Canadian economy. When interest rates are lower, people feel richer and they tend to borrow more. But if they increase over the medium term, people could find it harder to make ends meet and ultimately risk defaulting on their debt. Well, the government recently undertook action to try to fix this problem. A few weeks ago, they changed the mortgage borrowing rules so that the longest period someone can borrow for a house has been decreased from 30 years to 25 years. What they've effectively done is taking the riskiest borrowers out of the market, so they're able to maintain low interest rates without risking higher household debt for those that can least afford to borrow. This mortgage decision effectively places the Bank of Canada in a stronger position. They no longer have to worry about managing household debt when making interest rate decisions. Now they can focus solely on the economy. So if the economy starts to grow at a stronger pace than expected, they can raise rates to cool it down. Alternatively, if they find themselves in a position where they need to stimulate the economy by decreasing interest rates, they can do so without the risk of having to increase household debt. This is a great position for the Bank of Canada. So what's next is, the Bank of Canada is going to be meeting again in September on interest rates, but we don't expect they're going to raise rates again for the foreseeable future. If anything, they're going to be monitoring global economic developments to ensure the economy doesn't deteriorate too much. I'm Brunnen, and this has been a brief primer on Canadian interest rates. If you have a business or economic issue that you'd like me to break down, please email the address below and we'll see what we can do.